Most people think the goal of investing is simple: reach $1 million and you've won the game. But here's the part almost nobody talks about. For many investors, $1 million isn't the finish line at all. It's the point where money finally starts behaving differently. Because before that milestone, building wealth can feel painfully slow. Every dollar comes from your paycheck, and progress can take years to even notice. But once a portfolio reaches a certain size, the growth curve begins to change in a way most people never expect. The strange part is that the hardest stretch of the journey happens right before things start accelerating, and that's exactly where a lot of investors lose patience and walk away. In this video, we're going to break down what actually changes once investments cross the $1 million mark, why the math suddenly starts working in your favor, and why the people who stay invested long enough often see their wealth grow much faster after that point. To understand why the journey toward $1 million feels slow at first and why things begin to accelerate later, we need to look at the simple math that drives long-term investing. Historically, the U.S. stock market has produced average annual returns of roughly 8 to 10% over long periods when dividends are included. Some years are much better, others worse, but across decades, the market has tended to grow within that general range. Now, here's the key concept. There's a simple rule investors often use called the Rule of 72. It's a shortcut that helps estimate how long it takes for money to double at a certain rate of return. You divide 72 by the annual growth rate. So if your investments grow at around 9% per year, your portfolio would double approximately every 8 years. At first, that might not sound very dramatic, but once the numbers get larger, the impact becomes much more powerful. Imagine someone who has spent years consistently saving and finally reaches $1 million invested across retirement accounts and brokerage funds. If that portfolio grows around 9% annually, it could increase by roughly $90,000 in a single year without adding another dollar. Over time, that growth compounds. After several years, the portfolio might climb to around $1.5 million, and not long after that, it can move past $2 million. As the balance increases, the yearly gains grow larger too, even if the return percentage stays the same. That's the key shift many investors don't notice early on. When your portfolio is small, most of the progress comes from your own contributions. Your paycheck, your monthly investing, and your discipline are doing nearly all of the work. But as the portfolio grows, the balance itself begins to generate larger gains every year. Eventually, those gains can become bigger than the amount you're able to save from your income. And when that happens, the dynamic changes completely. You're no longer relying only on your salary to build wealth. Your investments begin producing growth on their own, and that's when the compounding effect starts to feel real. But the numbers alone aren't the most surprising part, because once a portfolio reaches around 7 figures, something else begins to happen that many investors don't anticipate. Your money may start generating income that rivals an actual paycheck, and that's where the next major shift begins. The purpose of investing was never just to grow a number on a screen. The real goal was to eventually reach a point where your money begins working just as hard as you do, or even harder. And when that happens, a new possibility appears. Instead of relying only on market growth, a portfolio at this level can also start producing steady income streams of its own. That's where the next shift in the wealth journey begins, the moment when investments don't just grow, they begin to pay you. Once a portfolio reaches around 7 figures, the conversation about money begins to change in a very real way. Up to that point, most people think about investing as something that grows slowly in the background while your job provides the real income. Your salary pays the bills and your investments are simply building for the future. But when your portfolio approaches $1 million, those two roles can begin to shift. Let's say a long-term investment portfolio grows at around 8 to 9% in a typical year. On a $1 million portfolio, that kind of growth could mean $80,000 to $90,000 added in a single year without increasing your monthly contributions. That number alone can be surprising, because the median household income in the United States is roughly in that same range. In other words, the growth of the portfolio during a strong market year could be similar to what many households earn from working. And this is the point where investing starts to feel very different. Before this stage, every increase in wealth required effort. You worked the hours, earned the paycheck, and invested part of it. Progress depended directly on how much you could save. But once the portfolio reaches a larger scale, the math starts to shift. Your investments are now producing gains large enough that they can compete with your earned income. Some years the market will be lower, of course, and returns are never guaranteed, but over time, the compounding effect begins to carry more of the weight. That's when many investors realize something important. The purpose of investing was never just to grow a number on a screen. The real goal was to eventually reach a point where your money begins working just as hard as you do, or even harder. And when that happens, a new possibility appears. Instead of relying only on market growth, a portfolio at this level can also start producing steady income streams of its own. That's where the next shift in the wealth journey begins, the moment when investments don't just grow, they begin to pay you. Once investments reach a certain size, another shift begins to happen, one that many people don't fully appreciate until they see it for themselves. Your portfolio doesn't just grow anymore. It can also start generating income. A large portion of the stock market distributes profits back to shareholders through dividends. These are regular payments that companies make simply for owning their shares. Some investors also include bonds, real estate funds, or other income-producing assets that pay interest or distributions over time. Individually, those payments might seem small, but when the underlying portfolio becomes large enough, the totals can start to add up quickly. For example, imagine a portfolio around $1 million invested in a diversified mix of assets producing roughly 2 to 3% income annually. That could translate to $20,000 to $30,000 per year flowing into the account without selling any investments. Some investors structure their portfolios slightly differently, combining dividend stocks, index funds, and other income sources. In those cases, the yearly income might move closer to $40,000 or even $50,000, depending on the strategy and market conditions. And that's when the numbers begin to feel tangible. Those payments could cover a large portion of housing costs, transportation, insurance, or other monthly expenses. Instead of your job paying for every part of your lifestyle, a portion of those costs may now be supported by the assets you've built over time. That's a powerful shift, because at that stage, investing is no longer only about watching your net worth increase. It begins to create financial breathing room. A portfolio can start supporting pieces of your life while you're still working, long before traditional retirement. But there's another change that tends to appear around this level, and it has less to do with income and more to do with how investors react to risk. When portfolios grow into larger numbers, the way people think about market swings often changes as well, and that psychological shift plays a major role in how wealth continues to grow in the years that follow. As portfolios grow larger, another change begins to happen, and it has less to do with numbers and more to do with mindset. Early in the investing journey, market swings can feel stressful. When someone has $10,000 invested, a major downturn might wipe out a few $1,000s. That loss feels personal because every dollar in the account came directly from their own effort and savings. But when a portfolio grows toward the $1 million range, experienced investors often begin looking at volatility very differently. Imagine a broad market decline of about 25 to 30%, something that has happened multiple times throughout history. On a $1 million portfolio, that kind of drop could temporarily reduce the account by hundreds of thousands of dollars on paper. At first glance, that sounds terrifying. Yet, investors who have already spent years building wealth often react in the opposite way most beginners expect. Instead of rushing to sell, many become calmer during downturns. They've seen market cycles before. They understand that corrections and recessions are normal parts of long-term growth. And rather than viewing lower prices as a threat, they begin seeing them as opportunities to buy assets at a discount. That emotional control becomes a powerful advantage, because over time, the investors who stay consistent through downturns, continuing to invest when others panic, are often the ones who benefit most when markets eventually recover. And that disciplined behavior is one of the reasons wealth often continues accelerating after the first million. There's another pattern that shows up repeatedly in long-term investing journeys. The early milestones tend to take the longest. For many people, building the first $100,000 might take nearly a decade of saving and investing. Reaching several $100,000 can require many more years of consistent contributions and patience. But once a portfolio crosses into the seven-figure range, something interesting happens. The pace of growth can begin to speed up. Not because the investor suddenly becomes more talented and not because the market starts behaving differently. The acceleration happens because the base amount is now large enough for compounding to have real force. At that size, annual growth can add tens of thousands of dollars, sometimes far more, even during fairly ordinary market years. Those gains are then reinvested, creating even more growth the following year. Over time, the snowball becomes larger and begins rolling faster. That's why many investors say the first million is the hardest stage of the entire journey. It's the phase where progress feels slowest and patience is tested the most. But once the compounding engine reaches full momentum, the entire dynamic can begin to change. Which leads to the most important takeaway from this entire discussion. If you're already investing and steadily building your portfolio, whether you're at $50,000, $200,000, or somewhere in between, you may actually be closer to that tipping point than you realize. Because in long-term investing, the biggest breakthroughs rarely happen at the beginning. They happen after years of consistency, right when most people are tempted to give up.